Hi, I'm Sam Slater from Fund Calibre, and today I've been joined by Zed Osmani, manager of Legg IF Martin Currie European Unconstrained Fund. Hi, Zed.
Hello.
So this is a high conviction holdings, and you normally ignore short-term noise and invest with a 5 to 10 year time horizon. Is that actually possible in today's uncertain environment? And how can you have so much conviction at times like this?
Yes, absolutely. The importance of our time horizon has to be highlighted right at the start. So we're thinking about 5 to 10 years time horizon, and sometimes thinking about some of the business opportunities we foresee in companies on an even longer time frame. And as a result of that, when we're doing our fundamental work, we're assessing growth and returns potential of any companies, as well as the sustainability characteristics of those businesses over that time frame. Which means that when we build conviction in any of the stocks that we're invested in, we do so without the short-term noise, if I can call it that way. And indeed, there is a lot of uncertainty at the moment in terms of economic shape, in terms of the recession that we're going through. And that uncertainty is exacerbated by the lack of ability to be sure about shape of a recovery from this very significant recession we're going through. But for us, thinking about 5 to 10 years as a time horizon, we're really thinking as the conviction in those companies, in their growth and returns prospect change over that time frame. If the answer is no, then we're comfortable holding through what is going to be a very turbulent period over the next 2 to 3 quarters at the least.
And some of the themes that you've had in the fund since you took it on include the future of technology, resource scarcity, and demographic change. Could you perhaps talk us through those and let us know if your view has changed at all on any of those due to the pandemic?
Yes, that's a good question. So you're absolutely right. We've got a framework which helps us think long term. We have identified 3 mega trends, which you have highlighted: the demographic change, future of technology, and resource scarcity. And if you think about it, these are mega trends that we will be sitting here discussing again in 10 years' time and beyond. So they're here to stay. Within those, there are themes that might evolve over time, but the importance of having these themes is to really get a good sense for where is the portfolio exposure and to be able to quantify those exposures. So if you look at the demographic change, we're very exposed to the emerging market middle class, to urbanization, and to the aging population. Those themes have not changed despite the recessionary environment we're going through. In future of technology, there are some themes such as cloud computing, which have become even stronger structurally as a result of the move we've all had to work from home, some of which will become sustainable, at least for part of that workforce. So cloud computing will be an important ongoing theme. Cybersecurity, as part of that working from home, is another theme within the future of technology, which will become even more apparent. So the structural growth prospects, we think, if anything, have improved. And then things like gaming, online gaming in particular, are in there. And clearly, as we've had a reduction in opportunities for external leisure activities, online gaming has indeed taken an important focus for some parts of the population. And therefore, we think that theme is important. Then when you think about resource scarcity, we're thinking about resource scarcity in the broader sense of the term. So it's not just natural resources. Indeed, food, water, energy are such themes within that mega trend. But we're also thinking about infrastructure as a resource scarcity. And we think as a result of this significant recessionary environment that we're going through, a lot of governments have responded with sizable policy responses. Fiscal stimuli and monetary stimuli, unprecedented at times for some regions. And we think those fiscal stimuli will find their way into the real economy through spending on infrastructure. And that's an important theme. And we can go into the detail of that later on in this discussion. But just to carry on the resource scarcity, We also see access to capital as a resource scarcity. So lending and investing is also a theme that is within that mega trend. And if you continue that reasoning, then education is a resource scarcity. And there are some attractive ways to gain exposure to access to education across the globe. And then finally, if you think about it, human capital is a resource scarcity. In some economies that are aging quite rapidly, more so than in others. But as a result of that, you can argue that robotics and automation is a way to play that resource scarcity. So you can see how that framework really helps us think very long term and in ways that is lateral, so that we gain the right levels of exposure across the portfolio to long-term structural trends, which we foresee as generating high returns. Of course, the final point to mention about those thematic analysis that we're doing is that valuations have to make sense. So sometimes we look at some of those themes and they are overvalued, in which case we're not going to touch them, of course.
And you once said that in the 1840s gold rush, it was the sellers of picks and shovels, not the miners, that made the best returns. Is this analogy still true today for any of your holdings?
Yes, absolutely. I really like the way you frame that question. When we think about the best way to gain exposure to some attractive structural growth opportunities, we always want to try and find a way to minimize the risk exposures for our investors. Let me give you an example. Electric vehicles is a very attractive long-term growth trend. We're forecasting the electric vehicle market to grow at 30% per annum to 2030. So it's a pretty explosive growth. And there are ways to gain that exposure. Clearly, the obvious way is car makers. Some of them are pure electric car makers. Some are making the transition from combustion to electric. What we prefer, of course, is to not have exposure to the forefront of the consumer, because if you invest in those car makers, you are exposing investor assets to consumer choice risk. And we don't want to make a strong call on whether one particular brand might sell more cars than the other brand. Consumer taste shift, and we want to really try and capture that 30% annualized growth in electric vehicle further up the value chain, where there might be some companies that are operating in niche areas, therefore where there's no pricing pressure in the way there is in the car makers, less competitive threats, therefore an ability for these companies to generate higher returns and have stronger pricing power. But importantly, these are companies that are providing the car makers with critical services or products, and that will sell those services or products to all the car makers. So that permits us to not have to worry about making the right choice of brand, but instead to capture that very strong growth potential and effectively sleep better at night. So that's one example. There are many other examples like that we can give you.
That's a great example, thank you. More generally, what's your outlook for Europe? I notice Italy is your second largest country weighting, although it's made up mainly of your holding in Ferrari. But how do you think Europe will come out of this crisis?
Yeah, it's another good question that permits us to highlight another important aspects of analyzing the portfolio in ways that are very fundamental. You're absolutely right. We have two holdings in Italy, Ferrari and Moncler. They add up to quite a sizable overall position to the tune of 12 to 13% of the portfolio. And so the traditional risk assessment would say that this is an exposure to the Italian sovereign risk, and therefore it is too high for portfolio diversification. And what we're highlighting is that these companies happen to be quoted in the Italian stock market, but they're actually global. So what we do with our analysis is we look at every company in the portfolio, assess where they generate their revenues and profits geographically, and then really just combine that data to assess whether this gives us exposures we want, the diversification we want, and indeed to ensure that we don't have any unintended risk exposures across the portfolio. And that's really what we call the fundamental risk analytics part of what we do. So whilst we're stock pickers and really focused on finding the best ideas and delivering them in a 20-odd stock portfolio, we also make sure that we have that very strong focus on risk analysis on the portfolio and focusing on diversifying even in a 20-stock portfolio. So in answer to your question about outlook on Europe, the importance of the European market is that there are a lot of companies that are quoted in Europe, but that actually have got very wide global exposure, and that give you good access to long-term sustainable trends such as the emerging market consumer in particular, the infrastructure trends that we've mentioned earlier that we think will continue to accelerate. And again, some European companies are leaders in that space. So we think, whilst the European outlook near term is very challenged, in particular for the Southern European countries, given the severity of the recession, we're actually looking at some companies that might have sold off as a result of that top-down macro fear that the market has, and that give us the ability to capture this long-term structural growth trends that we're talking about.
You touched briefly there on the emerging market consumer. We spoke to an Asian equity fund manager yesterday who said his greater worry wasn't the US-China trade wars, it was actually Europe's changing attitude towards China, and that it was becoming a bit more negative. Does this worry you in any way?
It's something that we're keeping an eye on, and the challenge with this question is it's very difficult to call the political dynamics and what will be the outcome of them. So from our point of view, we very much capture the political risk as part of our analysis, but we're also mindful that markets generally overemphasize geopolitical risk. And the challenge, the privilege of our mandate being long-term is over the long term, that geopolitical risk typically tends to die down, and the true intrinsic value of a company with all the fundamental attractions that it brings in terms of growth and returns comes through properly.
That's brilliant. Thank you very much. And if you'd like to find out more about the Legg Mason IF Martin Currie European Unconstrained Fund, please go to fundcalibre.com.